So is the market going to crash? Everybody's concerned about housing these days, the rising cost of not only rent, but of real estate in general. And if we look back at history, everybody says that what is going up has to come down at some point. And is that right around the corner? What's going to happen in the real estate market? Is now a good time to buy? These are all pressing questions. And so I'm very happy to be here today with a panel of experts in the mortgage and credit industries to talk about these issues and to look back at the history and to really kind of give us some insights in the future. My name is Will Dukes. I'm with the company's sales partners, and I'm proud to know each of these gentlemen and their expertise. So let's jump right into introducing them, give you a little background on what they do, and then we'll get into these questions and see what they have to say about them. So first off, we have the mortgage nerd, Phil Stevenson, and he has been the owner of PS Mortgage Lending for 10 years and is also known all across the internet as the mortgage nerd, has successfully defended that legally as well. So no one else could possibly be it. He has a degree in economics and 17 years of working solely in the mortgage industry, including during the last crash of 2008. He owns multiple businesses, residential real estate and commercial real estate. And Phil has unique specializations in reverse mortgages and VA mortgages for veterans, as he is also a veteran. Then Evan Russell from RCG Mortgage is the vice president of Russell Capital Group, where in just a few short years, he has helped grow the company to become a top 100 mortgage brokerage in the country and top 3 in the state of New York. Evan's 11 years of experience in the mortgage industry includes starting and developing a national wholesale mortgage platform for a mortgage bank, providing him with the operational knowledge necessary to be a top mortgage professional. Evan has earned multiple mortgage designations and is a certified mortgage planning specialist, which he uses to teach continuing education to real estate professionals. Then on to Roberto Riadigos, and he is the sales manager for American Portfolio Mortgage. Roberto has over 25 years of experience in the industry, and prior to joining American Portfolio Mortgage, he served in various leadership roles with Fortune 150 companies. He is bilingual with oral and written fluency in Spanish and English, and he is the 2021-2022 president of the Mortgage Bankers Association of South Florida. And in 2019, he was the chapter president for the National Association of Hispanic Real Estate Professionals. Roberto earned his MS. What is this, Roberto? His MS. There's junk on my screen. Roberto earned his Master of Science in Management from the National Louis University and his bachelor's in sociology from Northern Illinois University. Roberto resides in Miami with his wife, Lisa, and their 4 boys. Roberto enjoys attending Miami Dolphins football games, scuba diving, and golf. And Chris Colston, the founder and president of Second Chance Credit. He is an expert in improving credit ratings for individuals and businesses and is the credit educator and advisor for over half of the teams in the NFL, including the world champion Los Angeles Rams, as well as other professional sports teams and athletes throughout the UFC and other major leagues. His passion, though, is helping every American be able to maximize their financial well-being through the intelligent management and use of credit. So with that esteemed panel now in front of us, let's jump right in and hit that question that is on everybody's mind. Is the real estate market going to crash? And if so, is it going to be soon? And let's lead off with the man who obviously looks like he has the most technical knowledge right here, Phil Stevenson, the mortgage nerd.
Thank you very much, Will. It's an honor to be on this panel. And yeah, that's something that we keep hearing everywhere is, oh man, when is the market going to crash? It's going to crash. I've had clients not buy because they're anticipating the market to crash, but I have videos from 2019 saying that it's not going to crash. It's not going to be like 2008. So even before the pandemic, I was talking about this. One of the big reasons that people don't understand how many factors go into a market crash and what's happening right now with the values going up. One of the factors that's amazing to me, it's actually pretty staggering when I learned is, I'll just give you a tidbit first. When the market crashed in 2008, Roe versus Wade had an effect on that. Like, wait, what? 1972, I think it was, court ruling on abortions had an effect on it. So here, I'm going to share my screen and show you what I'm talking about. So over here, 1957, it's the peak of the baby boomers being born. Then contraception was here, late 60s, about 1970. And then Roe versus Wade was down here. So when Roe versus Wade came out, we had the lowest population, lowest of birth rates, new births. So the average homeowner, the time home buyer is at age 33. I always like to say between 30 and 35. So you add 30 to 35 years to this section right here, and you have all the years of the market crash, 2007, 2008, 2009, 2010. So while it wasn't the factor, these gentlemen are going to talk about a bunch of other factors, this was huge. But how does this translate into what we're going through now? Well, the largest portion of our population right now are millennials. Millennials are in the first-time homebuyer range. The bulk of them are between that 30 to 35 years old. So 1990 was the highest point of birth rates since the baby boomers in the 50s. And you add 33 years to this, and it's 2023. We're not even there yet. We're not even at the peak of the first-time home buyers wanting to buy their homes. Of course, people say to me, "Oh, well, millennials, and they can't afford these properties." But everyone here on this panel and other people, even insurance agents, an insurance agent friend of ours said, "That's crazy. Of course, millennials are buying. I've got 30-something-year-olds, low 30s, buying $1 million homes and complaining about their $25,000 a year homeowners insurance in South Florida." So it's happening. Maybe a lot aren't going to qualify, but the demand is what's driving this, and not just the demand, but the low inventory. So I'm going to change to one other screen before we.
Phil, I just want to ask you a question, real quick question, right? So with the birth rates, so when you mentioned, right, we still haven't seen the peak of the demand. That's because at or about 1990, that's when we saw the peak of birth rates. So what, 2023, right? 33 years old, that's the average age. That's what you're referring to, right? We're right there. We're not even at the peak of the demand yet.
Correct. We're right in the mix of this high demand for first-time home buyers. And if you follow the 33 year exactly, 33 years will be 2023 from that 1990 peak. And then, as you can see, if you saw on that chart, then it starts to decline a little bit over the coming years. So maybe in 5 years, where if there's the right mix of different scenarios, values are too high, rates are high, a recession, then maybe we'll see a crash at that point or a correction, but it's too high. And right here on this chart, let's look at inventory. This squiggly line back here, this is inventory. So right now, 2022, we're at 900,000 homes for sale. Let's look at 2008, at the peak of home inventory. It was 3.7 million in this 2007, 2008 range. So we have a quarter, 25% of the inventory currently than we had when the market crashed. But more importantly, let's talk about the population that I was saying. So that's the supply side. The demand, this line right here, is the US population in millions. So if we look at 2005, right here, at probably the peak, 2005, 2006 of the real estate boom, inventory was rising, less people were buying, there was more people selling and they couldn't sell. And then the population was much lower than it is now.
So to kind of just put some perspective on that, Phil, like we can look at that chart there and the green kind of smooth line being the demand. Whenever that blue line is above that green line, that's going to have a suppressing effect on prices. There's more supply than there is demand for housing. But now we're in not even just a correction of that. I mean, it is this huge gap in the point now where the supply is so low, but yet we have these population effects of people being born now, turning 33, coming into that age. And so there's no artificial demand being created here. It is just natural supply and demand, basic fundamental, freshman year economics.
Yeah, rising. And back then rates were lower than mortgages. Now the rental rates are higher than the mortgage payments, so you can sustain it. You don't have to, you're not like upside down $500 a month, so you just let the house go to foreclosure. Foreclosures are their lowest in history right now. And my last stat is that in 2006, income from 2006 to now, I only heard this in the last week or two, has gone up 55%. Household income has gone up 55% since 2006. people might think that's crazy. Teachers, nurses, they don't make more money. Yeah, maybe they make 5-10% more, but there are other professions that are making 100% more. So the average is 55% that's gone up. So I don't see this stopping. And I think kind of unfortunately, I think we need this to slow down. We need more inventory. We need a balanced market. It's always better when you're balanced. So that's my segment.
So that, I mean, it's very, very interesting to look at the fundamental economic drivers in there. But we do know that it is also cyclical. And as you alluded to, there are a lot of other factors that came into that. And so I'm interested in kind of, regulation. And, one of the reasons inventory is so low is, because of kind of a suppression of new development and stuff. And we all hear about those kind of stories, but just kind of these natural cycles of things too. And Evan, I know that, when we had talked before, you talked about the 2008 bust and that big spike in sales and everybody coming into that. Like, there was a lot of regulatory influence on that. That we're not seeing right now too. So explain that a little bit.
Yeah, tremendous. Again, just as Phil said, definitely feel privileged to be here with all you guys, right now today, to be able to, what I feel, debunk the myth that there is going to be this massive crash. And when we talk about the crash, when we hear individuals discussing the crash, real estate professionals discussing a crash, everybody's really gearing it towards and talking about 2008. That's what everybody remembers. It's recent. Yes, real estate is cyclical. So everybody wants to feel or wants to think that that's coming again. Phil, you did a phenomenal job explaining, like you said, Will, right, the basic economics of it. And what should drive values is simple, basic 101 economics, supply and demand. That should be the driver. And as of today, in the market we're in right now, that is the driver. We have to, to kind of debunk the theory that we're going to have another 2008 right now, or really ever for that matter. We have to really go back to history and understand, the events that kind of led up to the crash itself. We had 30 plus years of deregulation and really just kind of a reliance on self-regulation of financial institutions leading up to 2008. The 70s, 80s, 90s, achieving the American dream of home ownership was a massive push. Getting everybody to be able to buy a home, right? Everyone should own a home, when in reality, everyone shouldn't own a home. Everyone isn't able to own a home from a financial, from the financial purview of, or financial perspective. So over those 30 years of, deregulation and reliance on self-regulation of financial institutions, we neglected the inherent risks that were building and compounding, creating what became really an artificially driven market. And I'm going to talk about two things. I'm going to talk about appraisals, and I'm going to talk about mortgage guidelines, subprime mortgages.
Just before you jump into those, though, can you just back up into that idea of self-regulation? Like when you say, like, the self-regulation of financial institutions, like just good lending practices, like just common sense type things, like maybe not, that's not necessarily that common. What do you mean by that?
Exactly. So good lending practices. So, I mean, ultimately we had, loans that were going to be guaranteed by, the federal government, because the federal government was, pushing the dream of home ownership, and the federal government wasn't, didn't have in place the regulatory agencies that they have now post 2008, after realizing if we're going to rely on these institutions to have, good lending practices while we're guaranteeing things, they're just not going to, right? I mean, they're going to look to soak up the money. And that's what took place, quite honestly. Self-regulation was not going to work. It was never going to work, especially with the federal government backing, some of these loans. So yes, good lending practices is what I'm referring to. And there just weren't those good common sense lending practices, because of the environment that was provided to them. So, leading up to it, like I said, the appraisals and the mortgage guidelines. So subprime mortgages and appraisals. First and foremost, appraisals. And when I'm talking about appraisals, I'm really just talking about values. How did we get to the heightened values that we saw in 2008? How did they get there? They didn't get there just by virtue of supply and demand like we see right now. What happens is, when you go for a loan, when you go for home financing, right, the bank is going to send an appraiser to that property, and the The appraiser is going to appraise the property based on the market value, right? What does basic economics tell you? There's supply, there's demand, there's buyers, there's sellers. They come together, they have an agreement, they decide on a price, that sets the market, that sets the market value. Well, an appraiser comes in when you're purchasing and financing a property and will determine and confirm whether or not that is in fact the market value by looking in the surrounding area at comparable homes. Prior to 2008, prior to the overhaul of regulation that we saw, these appraisers were significantly influenced by real estate professionals and mortgage professionals. So when a home goes up for sale, a real estate professional is the one who sets that price. And when that price is set and a buyer comes along and purchases it, goes into contract for that price, and then goes through the financing process, and an appraiser comes along, unless the appraiser appraises it for that price, they're not going to be able to buy it. Well, through the influence of real estate professionals and mortgage professionals, there was artificial inflation of these appraised values. So these values just weren't real, quite honestly. They were fake in most places. So we had that as a compounding issue happening time and time again.
Just to break that down, just so everybody can catch that. So if somebody wanted to sell their house for $400,000, if the appraiser didn't say, well, that house is really only worth $350,000, they're not going to be able to get the mortgage for that $400,000 to buy it. They would have to come up with the cash or do something else out to make that happen. But the market was so hot, and there was kind of like these behind under the table kind of deals, like, hey, bud, don't kill my deal. Make sure you appraise it for where it needs to be so this deal can go through. And it wasn't a fair evaluation of the value.
Yeah, common practice. Yeah. Sorry to interject. Your common practice was, hey, appraiser one, what value can you give me? 380? No. Hey, appraiser two, what value can you give me? 370? No. Hey, you can do the 400? All right, let's go. And now there's a middleman preventing that.
So, exactly. So there was artificially there were artificially inflated values is what it really came down to, because of exactly what you just explained, Phil. So we had that. What happens next is, mortgage guidelines and subprime mortgages. Subprime mortgages including, 100% financing with what we knew as NINA loans, no income, no asset, no verification of income, no verification of assets, no verification that these individuals had the ability to ever repay this mortgage, or that they were ever going to be able to repay the mortgage. Balloon payments where, 5, 10, 15 years after buying your home, you owed hundreds of thousands of dollars on demand, which you just weren't able to come up with. Negatively amortized loans, adjustable rates that spiked payments. Again, buyers, all of a sudden, payments go up $500 to $1,000 a month. They don't have the ability to make these payments. What comes next? Foreclosures. Yep. A massive amount of foreclosures. And once those foreclosures took place, the market that we saw, which was artificially inflated by means that I just discussed, was truly exposed. And we saw a massive, massive crash. Thankfully, it happened because we wouldn't be in the economics 101 market, I feel, and we feel, and that's kind of what we're talking about here, that we're in now. Because once that happened, it required the overhaul of regulation through the Dodd-Frank Act and many other, regulatory moves coming down from the federal government that changed the mortgage lending market forever, for the better, truly.
So a lot of those regulations kind of change some of these things. Like Phil said, now there's a middleman in the appraiser. You can trust the appraisal. It's not, they're not being unduly influenced by that. The mortgage guidelines came back. It's like, all right, you can't be making $29,000 a year and just tell the person that you've got a side hustle that's bringing in an extra $50,000 a year, and now you can get qualified for this $500,000 loan that you obviously can't make the payments on in 3 years and crash everything.
Exactly. We're not going to allow you to finance 100% of your property with nothing down, no skin in the game, with you just telling us what you own. No, we're going to verify it via income documentations and a whole slew of different measures. As far as appraisers are concerned, exactly. The middleman that Phil is referring to has to do with a management company. At the end of the day, there's a round robin of appraisers that mortgage professionals, lenders, brokers, et cetera, have to order through, and there's something called appraiser independence requirements, where we ensure the appraisers originators are handling their business independently of all professionals in the transaction. So by virtue of those regulations, the mortgage, the mortgage lending market transitioned into a market that can be trusted and created a foundation that we can feel strongly about, moving forward.
Well, and I think it's also important to point out that, at least from my perspective going into it, from the general layman, not a real estate professional, but all those different loan products that you mentioned, like they're all legitimate products, and they had their uses before, and maybe now, like some of them aren't there anymore, but the majority of them, like the adjustable rate mortgage and things like that, things that were traditionally geared to investors, right? That had a financial understanding of what they were going to do. They had a business plan for these real estate transactions. Now, all of a sudden, those become available to the random person that doesn't know what they're doing, and somebody's just showing them numbers on paper. It's like, look, oh, you're paying, you can afford this payment. Well, yeah, you can afford it for 3 years, and then all of a sudden, if you haven't sold that house like the investor was going to do, now you're going to be in the lurch.
I think one of the most important things was the onus put on the mortgage loan originator, the mortgage professional, licensing requirements of the mortgage loan originator. And also, I mean, it actually only happened recently, but our NMLS numbers, which are just our license numbers, are on mortgages. These are recorded documents, right? So in the future, 10, 15, 20 years from now, if there are foreclosures, et cetera, our information is on there. So yes, to what you were saying, Will, there were mortgage loan originators who really had no, they had no worry. They weren't even, after the fact, they weren't involved. They sold the loan, they were gone. See you later, bye, right? So they sold adjustable rate mortgages to people who really didn't need them and that were set up for failure. They sold balloon payment mortgages to people that really didn't need them and were set up for failure. So I think that was one of the most important pieces, is the licensing requirements of the mortgage loan originator and the onus put on the mortgage loan originator and the professional to really guide these clients in the proper way to set them up for success, not failure.
So now we can combine two of these things. Now we're seeing these stark differences in just the pure fundamental economics of supply and demand. We're seeing differences in the regulatory environment around that. And so the people that are driving the demand right now, it's not that they can't afford these mortgages. There are all these safeguards in place. So that's not likely to cause some big crash now. So when we look at that, like, okay, the market is still strong just on its fundamentals. People are maybe backing off of it because they've seen this rise. They are scared about it. But what does that mean? What is that going to cost them? And I'm interested in hearing from Robert on this. But Roberto, if somebody doesn't get in the market and it continues on, maybe if it just slows down, right? Like, if the property values don't just skyrocket like they've been doing, but interest rates are going up. We've seen the Fed announce that the base Fed rate is going to go up, and that affects mortgages, and it gets a little bit more complicated. And I know Phil's got a lot of great videos on how the mortgage interest rates get calculated. But the reality is, we all are pretty much aware that the interest rates are probably going to go up, and that may affect demand. But if you are in the market to get a house, what is it going to mean for you?
So thank you, Will, and guys, appreciate being part of this panel and the opportunity to share some information. So it's a missed opportunity for those that want to be on the sidelines. When people are asked what's the best time to buy real estate, it's the same answer as when's the best time to plant a tree 10, 20 years ago. And so, it's a matter of being in the market, not trying to time it. And, I looked at a couple of things. There's several variables that go into determining what interest rate you qualify for. And at the same time, there's also different variables that go into how a property appreciates. The type of property, is it a single family home? Is it a condominium? A lot of things can vary. Obviously, location, where are you located? But I did a couple things. I looked at a few samples of buyers that I actually closed their loans in 2021 and 2020. So I looked back at some of the loans that closed last year and just kind of looked at where their values are today versus where they bought. And there was a range, and the range was obviously there because of the type of property and the location. But on the low end, I saw an appreciation of 13% to as high as 20%. So right there, that shows you that your missed opportunity in just the fact that you have a level of appreciation is there in the property that you're purchasing. I look back 2 years ago, those ranges were as low as 23% and as high as 33%. So just looking at the asset you're purchasing, you're going in and over a course of a year, your rate of your return is over 10%. Looking over 2 years, your return is over 20%. So right there, we've been fortunate to see an increase in property values, and that's your first missed opportunity if you waited a year ago or 2 years ago. But in terms of the question about interest rates, same thing. Interest rates will vary based on your credit score, based on the amount of your down payment, based on the type of property. If you're doing an FHA or a VA loan, you have a government loan versus you're doing a conventional loan, Fannie Mae, Freddie Mac, that's going to vary, a jumbo loan. So there's many types of loans that'll influence the interest rate that you're getting, as well as the property type. If you're buying in a duplex versus a single family versus a condominium, all that can have an impact on your interest rate. The occupancy, will this be your primary residence, a second home? Will it be an investment? So to keep things simple, just for this comparison, I looked at rates roughly in the threes, at 3 1/8. If you were an average loan size of about 400,000, you would have about a $1,700 payment. That $400,000 loan at 3 1/8 would give you about a $1,700 payment. If you look at your total payback over 30 years, you're paying back $616,000. Now let's look at where rates are today. We're about 100.
And just to break that down for everybody. So $216,000 of interest cost over the life of that loan, if you got in at a 3 1/8 interest rate, and at the same $400,000 house, which is about an average in the South Florida market right now.
Right, you'd be fine.
That's where they were about a year ago, maybe a little more than a year ago. You could get that 3 1/8%, but that's not where we're at now.
That is correct. So looking today, roughly, we're probably in the low fours. Again, for comparison, rates going up about 100 basis points, you're at 4 1/8. You're 1% above where you would have been about a year ago. What does that do to the payment? Now you're at $1,938. So automatically, it's costing you about another $225 a month. But for me, the big comparison is $225 a month. That's about $2,700 a year. Then when I look at that same total payback, instead of being at $616, now I'm at $697. That's an additional $81,000 over the life of the loan. So right there, that's look at it from a monthly basis, $225 a month, annual basis, $2,701, and over the life of the loan, $81,000.
Well, and put that in perspective too for folks, that extra $220 some odd dollar, I'm like, that's my daughter's college prepaid, payment into her prepaid college plan. And everybody's got all those different things, but the same value of a house, which is now less house than it was a year ago because of the appreciation, getting that same $400,000 loan, you're paying more for it just because of the environment of interest rates that could be going to other things. And even if you were just investing that into your own retirement, that $225,000, that's $81,000, which over those 30 years could grow to several hundreds of thousands of dollars. But you're putting that into not even into the value of the property, it's just going to interest.
Exactly. So the biggest question is, well, where are rates going? Where will we be a year ago? So that same comparison of 2020 versus, or 2021 versus 2022, what will 2023? Obviously, we don't have the crystal ball. We don't know where we're at, but what we've seen in the first 6 weeks of 2022 is that rates have gone up. They're going up. And so what if rates continue and next year we're at the same 100 basis point increase and rates now are at 5 1/8? So that same $400,000 loan now costs you $2,177 a month. So that's an additional, versus 2 years ago, the 3 1/8, that's a $464 a month increase. That's a $5,573 increase over the course of the year, or over the 12 months. And the biggest jump is that now my payments over the full 30 years are $784,000. I have an increase. And when I look at that compared to 2 years ago, I look at that missed opportunity, not only in your appreciation, but in the life of your loan, you're looking at $251,000 in missed opportunity. So,
sorry to interject there. I just want to just remind everybody, like, we've been in kind of these low interest rate environments for a while, like since the crash, kind of, maybe average where we're at, but like 5 1/8 interest rates are not unheard of anytime. Our first house we bought, I think we had like a 6 or, somewhere close to a 7. And we were amazed by how much more house we could afford when we moved because interest rates were that much lower. And so it's a big impact on the value that you can put into your net worth and the asset that you're building there just because of the changes in interest rates. And it's likely to be going up.
No, without question. I mean, the message is, to me, is very clear. It's a matter of buying in now, looking at appreciation, what you're missing out on that property increasing over time, and the interest rates, how that impacts you. That's why we had so many refinances over the last couple of years, because people were taking advantage of that. And so, that's obviously getting in and owning the property is the smart move because of the fact that you're securing that asset based on today's prices. And with everything that we've heard with the supply and demand, the birth rates, it just tells you that the likelihood of appreciation is going to continue. And if, for me, that I'm in South Florida, that's another piece altogether, because there's so much demand here outside of everything that we see across the country. South Florida is unique because it's bringing in people. How we look at, we don't have state income tax. There's a ton of different things that we can look at of why people are moving here. COVID, the ability to work remote. There's a demand here that, again, getting into the market, buying something this year is going to put you in
well, I want to ask everybody about that a little bit later and kind of like these movement trends, but like to stick with the interest cost, like the man here that knows a lot about the effects of interest on people's livelihoods is Chris. And so I'm in the hard thing for a lot of people is they get caught in the trap of, well, can I even qualify for a mortgage right now? Or maybe I was, all the things of COVID and everything else had happened. So what's going on with just people's debt in general that is affecting the market and demand as well?
Well, thank you very much, guys, for having me here as well as part of this great panel. I know all of you guys and love you very much. So it's a true honor to be here. But I wanted to touch some things there with what Robert was saying. What is the best way to control your home payment, right? Your rental, your mortgage payment is to actually be a homeowner. Rentals are going up like there's no tomorrow. Inflation in that is crazy. I used to have an apartment in South Florida that was paying $2,500. The day that I moved out, I'm friends with the property manager. They rented that apartment for $4,300.
Holy
Same
cow.
Same apartment. So imagine so people playing the sidelines is because they're scared. They're fearful. They're fearful because they're not getting the right information out there. Many people are telling them, you cannot get this, you cannot do this. And there's no education on how they can achieve this. This is why I believe we're doing this panel, to create education, create knowledge that people can really do this and not waste money on renting, because there's so many people that will just rent, and they have nothing to show for, So I think that's a big thing. We need to get these clients out of the sidelines, and the way to do so is with education. But talking now about the debt, Will, that you were saying, debt right now in the last quarter has increased by $52 billion. October,
that's just in the
November,
U.S.
December, in the U.S.
Just in the U.S., just in the last quarter, not over all of 2021, just in the last quarter, $52 billion over 350 million people.
$52 billion. So it is so crazy to know that, because also 30% of your credit score is based upon debt that you owe. And most of it is credit card debt. So we're digging ourselves into the hole, and this is why we cannot buy. This is why we're not taking advantage of these great opportunities, because we're being told, go and purchase. Now, the people, the individuals that are very wise with their money and credit are the ones capitalizing, or the people that have the right team behind them are the ones capitalizing. They have the right taxes, right? So they're not just sandbagging their taxes, they're capitalizing. People that are saving money, capitalizing. And I'll tell you this, why am I telling you this? Right now, what Phil Stevenson was saying about the credit scores, right? The 33-year-olds, 30 to 35-year-olds, the average credit score between someone that's 30 to 39 is 673, the average credit score. Average credit score for people that are 40 to 49, 684. Average credit score between 50 to 59-year-olds, 706. You want to know right now what is the average credit score in America right now? It's the highest that it's ever been. I've never seen something like this. It is 711 right now, the average credit score in America. We're seeing in our firm more 800 credit score files that we have ever seen, ever. So, but I think also it's a case that these clients that we have are highly educated, and they're preparing themselves to capitalize. Every single client that I have coming into my firm, they're people that are very intellectual. They got their things, all their ducks in order, saying, I want to get back into the housing market. I want to go and buy more. I'm not seeing these people with big money being shy about it. You know how they say when things are too good, a lot of people shy away from it? No, these individuals want more and more and more, because they know that others are not capturing this big opportunity, because they see how their properties have increased. They have seen how these investment properties, when they rent them, they Airbnb them, they're making money out of it. So it's a thing that a lot of our clients here, right? The demographic is the Hispanic, African American. They're not gaining too much ground because of all these clients coming from the northern states, right? Right now, the state that has the highest credit score is 739. We're talking about the Wisconsin, the New York, the Boston people. So all these professionals with this high credit score, high net worth, all the financials and everything, they're coming down here in South Florida and grabbing everything because they're prepared.
Well, and that goes, we could probably do a whole other segment just on, the state of financial education and how people get caught in kind of these debt cycles and, personal things. But I think it's very important to stress that that first point that you made, the only way to lock in your housing payment is to own your house. And even then you're going to have taxes and insurance and stuff like that will fluctuate. But, going from $2,500 a month in housing payments to $4,000 a month in housing payment, like that can wreck somebody. And if you're continuing to rack up debt and you're not understanding how all of these things work, that's going to be a big hindrance on your overall financial well-being. And we're seeing that. We see a lot of that in social media, I think, and people coming out and complaining. And you look deeper into it and you just understand that, unfortunately, it's not taught in the school system. If your parents didn't understand that, who were you going to learn it from? And to your point, Chris, I think that's part of the reason that we're having this conversation. So with all of that outlook that we've talked about, like we don't see the market fundamentals driving any kind of bust anytime soon. Interest rates are likely going to go up. There's greater competition for the limited number of properties there are with people who were better financially educated. Yes. And that we could also throw in there too, like people coming from New York or from the West Coast, with remote work and everything else, they're able to move into these areas where they had very high incomes because of the cost of living there. But now they can come in and buy in areas where cost of living wasn't so high. And so that competition is just wrecking people. And like you said, it causes a lot of disparity and economic disparity as well. But the only thing that's going to change that is educating people to make them more aware of how these systems work and helping them to make other choices and sacrifices too. So I think this kind of brings all of our conversation back to what should people do in this situation? I think it's kind of obvious. Everybody's leaning here, like, we got to get in, you got to get into the market somehow, but that doesn't necessarily, that's not always easy, right? Like when you see the crazy competition in Miami or in some of these other cities, I'm sitting here in Orlando right now, Evan, maybe it's calming down in New York. I don't know because everybody's leaving, but it's coming back, right? It's just as crazy up there as it is down in Miami. So what can people do? And we'll just kind of like open it up, have some interjection.
Yeah, I would say that, you really need to get with the professionals. That's what you need to do. You need to get with the professionals. You need to get to the right team. And Chris, you might have even just been jumping to that point, that you need to have the right team around you, which consists of, credit and finance experts, of which, are on this panel right now, so that you can understand exactly what opportunities you have out there. So, what I like to do is I like to do a lot of, CE, continuing education courses for real estate agents who are front facing with clients, and also doing a lot of home buying seminars, first time home buyer seminars. People don't realize the opportunities that are out there. The biggest limitation, I'd say right now, that I see for people that are trying to buy a home is asset based, is the amount of money that they have. There are opportunities by virtue of VA loans, for veterans specifically, that offer upwards of 100% financing. There are opportunities by virtues of lender credit, sellers concessions, which can get you into the door with, small amounts of actual cash, $8,000 to $12,000, as low as that, into a house. There are grant programs that allow you to get into a property with as little as 1% down of your own money. So, opening up the door to the education and being able to show these homeowners that it is doable, I think that's the most important thing, is surrounding yourself with the right team in order to be educated properly and understand that you have the opportunities.
Well, I think that's very, very interesting. I want to jump to Phil real quick, Chris, because Phil was the first person who put that thought in my mind, that like you can lock in your housing payment by getting a mortgage. I wonder if you can explain that a little bit more, but also talk about, maybe some of the trade-offs or the decisions that people have to make, in about where they want to live. And is it worth it to maybe look at some places outside of where you would normally be comfortable just to be able to get into the market?
Yeah, well, I guess an example there is my brother-in-law left South Florida. He's now closing on a property in Sarasota. So, he went somewhere where his quality of life would be better. His wife can work, pretty much anywhere. She was able to transfer. He works online. So yeah, we're seeing a lot of that. A lot of people leaving a lot of metropolitan areas, whether they're coming from somewhere like New York and California to Florida, or within Florida going to other outlying areas. But I get, when I'm in front of people live, I've lately asked the question, I said, whose mortgage payment in the last year has gone up 30%? Nobody's mortgage payment has gone up 30%. Your property taxes, at least in Florida, can only go up 3% a year. So that's a portion of your payment that only goes up 3% a year.
On your primary residence, your homestead.
Correct. Yeah, on an investment, it goes up, it's capped at 10% in Florida per year. Now, and again, that's only payment. Now, the rent in Miami-Dade in 2021 went up an average of 30%, which is staggering. It's the largest increase in the country. Chris just mentioned his property, which had gone up 72%. I did the math really quick here. And also, in something Chris said about Airbnb and VRBO, none of us have thought about it or said it. That didn't exist in 2008. So you either bought and rented long-term, or maybe you were able to somehow do vacation rentals, but now it's facilitated where I sold my house in Miami. I live in Key Largo now. I sold my house in Miami and I bought 3 properties with it. They're all vacation rental Airbnb. So now I can be in like a hotel owner and rent it at higher than you would on a regular monthly basis. So how many people are doing this? This is only feeding this drive in the market. And my last point, if people are like, well, isn't the demand going to go down with the interest rate? Yeah, for sure it is. What Robert said is staggering. A payment to go up $400 like that. But if, let's say, you have 10 or 20 offers on a property right now, and half the demand goes away, you're still talking about 10 to 5 offers on a property. It's still pretty crazy what's going on.
Yeah, it absolutely is. So what's Chris, what do people do about that?
You know, seeing everyone here and knowing everything that you guys have achieved, the only way you guys were able to achieve this is by knowledge, execution, and preparation. We just have a bit more knowledge than others, but that doesn't mean that the knowledge is not there. If we get the right team to guide us, and this is what we're preaching here, you know, to our future clients, hire the right team to guide you. Because yes, you need the down payment. Yes, you need to have the capital, but also you need to have the credit. You need to have that not so high debt. But how are you going to know this if you do not know this? If you do not set up the proper team, you need the preparation there, because everything can be achievable. What Phil Stevenson just did, he sold one property and bought 3. He's probably getting a bigger ROI, return on investment, on those 3 properties than if he would just have rented that one house. Everything can happen. We just got to prepare and set ourselves to the future.
Well, so Roberto, what should people be doing to prepare right now? Or if they're in the market, maybe they're getting frustrated. I've heard plenty of these stories too, of, people just kind of give up because they put an offer in on 3, 5, 10 houses, and they're constantly getting overbid or something. But we're kind of, I think, all unanimous here that you shouldn't give up. But what's the practical thing for them to do?
So without question, everything that was said about, getting a team together, getting that mortgage professional, getting the right guidance. One thing that I've seen a lot more is I'm getting multi-generation applications. I'm getting applications with husband and wife, and because of the price point they would have never found a property. All of a sudden they bring in mom and dad, or they bring in adult children, and now with 4 incomes, they're at a price point that they would have never been at, and now they're able to compete a little bit. So that's one thing. Not advising go live with your parents, but it's happening more and more. When it comes to the preparation, the other thing that I see a lot, South Florida, I deal with a lot of self-employed borrowers, and there is a huge disconnect in what a tax advisor is saying to avoid paying property, or to avoid paying income taxes, and what's allowing you to be mortgage ready. And so there's a lot of conversation around, no, I can't just use the 1099 figure because you wrote off so many different expenses. That net amount is what I'm using. Now, there's a lot of variances to that. There's actually programs that for self-employed borrowers that are non-traditional that allow us to use bank statements, things like that. But the bottom line is, you have to get mortgage ready, and the mortgage professional is the one that's going to review your credit, review your income, your assets. And if you're not ready to buy today, give you some strategies of how to get there. And even with assets, just cash is not king. When you have that money under the mattress, as they say, there's certain ways that you have to get that because of USA Patriot Act, that I can't just use cash. So all of those different variances of where people are with their income and their assets are things that they need a strategy and they need guidance on. Credit is a big one. There's tools that we have as mortgage professionals that didn't exist in the past. There's a wayfinder where I can say, how do I get to a 700 credit score? And it'll give me advice on how to do that. There's a what if scenario where I can tell somebody, if you paid off this credit card, your score is going to jump 20 points. Well, what does that do? That's going to give you a better interest rate. It's going to give you better terms. And in some cases, it may make the difference of whether you get the loan or not. I've had people where I run what we call the desktop underwriting, the automated underwriting. They don't get an approval. They've paid off a credit card, their score jumped, and all of a sudden I have an approval. So none of that you can necessarily do by searching things online. You need somebody that's actually going to have that conversation with you and give you that guidance. So without question, what do you do next? You need to seek professional advice and from a mortgage professional, credit restoration company, whatever is needed, people that do this day in and day out, that can give you the strategies you need to get the best terms available and get you into a place where you can have a competitive advantage to be able to secure a property.
Well, we're
The
going.
longer you wait, the longer you wait, the longer it's gonna take for you to get there. So, I just want to say that, personally, I've had many clients, and I'm sure we all have, but I've had many clients that I've referred over to Chris Colston, with Second Chance Credit, and in a month, 2 months, 3 months, depending on the scenario, he's gotten them to a point in which the credit was credit worthy enough for me to, get their purchase done. But if they waited 2, 3, 4, 5 months later, right? Well, then they're 5 months, late to the game, and with rates going up, who knows where they would have been at that point. So yeah, that's definitely what you need to do, is get in the game, get to us now.
We've got to wrap up here because I know we're coming at time. I want to give everybody kind of a moment, but I think Chris, that's certainly a strong recommendation. I know we've had a lot. That's what you do, is help people to repair, build, maximize their credit to that. So if people are in those kind of situations where maybe they're just out of reach, and maybe just the simple kind of wayfinder things don't do, like what are some other things that people can do to help improve their credit? Other obviously they can contact you, and I know you can go through a deep dive consult with them, but some of the simple things that they need to be thinking about that most people don't even know, like you said, 30% is just on debt.
The most simple thing to do, and it's the hardest, right? Because it's so simple, it's so hard for people to do. Just go on a debit card diet. Use your debit card. Pay off all your credit cards. Stop buying shit. Stop buying shit. Go on a debit card diet. You will increase your credit score by 30%. Phil Stevenson said, has your mortgage gone up by 30%? Well, you know what? Your credit score could go up by 30% just by cutting off debt. Simple as that. Start with that, clients. Start with that. Then afterwards, there's other things that we could kick in to make it stronger. But the first step, debit card diet. Stop buying shit.
Stop digging yourself in a hole, and then Chris can help you out of it.
Yep.
All right. Good stuff. Gentlemen, any other closing thoughts on what people should do? I think we've made the case that we're, even if the market levels off, it's not crashing down anytime soon. And rentals are probably only going to continue to rise because of Airbnb, because of just the demand for housing from the population and the migrations that we're seeing all over the place. So closing thoughts before we wrap it up.
We've debunked the myth. I mean, I feel we've debunked the myth by virtue, by explaining the myth that we're going to see a large crash, by explaining what events took place that led to the crash in 2008 and what corrections were made after the fact, overhaul of regulation in the mortgage industry, to make sure that they didn't happen again. Phil mentioned birth rates. That's a tremendous piece. So demand is still here. Foreclosures, Phil also mentioned all-time lows. That a large portion of that has to do with the fact that buyers are strong. These are qualified buyers because of the regulation. So I feel we've truly debunked the myth that we are going to see a mortgage crash. Will we see a correction because of a number of factors? Absolutely. We should see a correction, but we will not see a crash, which means get into the market.
I think unanimously, when we were talking about this beforehand, that was our thing, is just get in. It doesn't matter, oh, you wanted your dream house and you can't afford it. Well, then don't get your dream house. Get a condo that you're not completely happy about, but you're in. And then a year from now, you can move up, and sell that and get something else. There's so many things that you could do. In 2015, I was out looking to rent for my office. And instead I bought a commercial building that half of it is being rented. Best investment ever. Now there's got to be over $1 million in equity in that property, which is staggering. It's like you put in 200, you get $1 million. I mean, it's a bigger scale. A lot of people, of course, aren't doing that, but do it even at a smaller scale, a small condo, and then move up. That's my advice.
Well, like somebody just threw it out there. I think, Chris, you could go move up to the bigger condo, and you can Airbnb that one and have it be paid for itself. And that's how people build wealth. Roberto, any closing thoughts from your perspective?
Yeah, no, I think this has been great. Again, thank you for the opportunity. I think that we summed it up. Bottom line, get in the market, go seek a professional that's going to sit down with you and walk you through what your strategy should be and how to get there. And again, it's all about having a plan, being prepared. Whatever happens now going forward this year, if things slow down, that could be an opportunity. So that buyer that's been frustrated, this might be their opportunity. This summer, things might be where there's a little less competition, and that could be an advantage for you. So thanks.
Leverage your credit. The stronger your credit rating, the stronger the file, the paperwork will be. So if everyone has money, but not everybody has the strong credit, now you're going to be the special one. Imagine you have that 740, 760, 800 credit score, and you have the assets, you have the deposit, you have everything. You're going to move to the front of the line. That's what you want. So that's my advice. Start building that credit stronger than what it is.
Well, very good, gentlemen. I believe you have given everybody a very solid analysis of what is happening, and certainly some key things to think about, considerations. And I look forward to having more of these conversations, because we could dive into a lot of these topics a lot more in depth, I believe. But it's been a great conversation so far. So I hope that everybody that has been listening to this, whether you are in the market as a buyer, whether you're a real estate professional, and you're looking to share some of this information with the folks that are in your space, go spread it, get the word out that people need to act, because the market is only going to continue to move whether they do or not. With that, everyone be well.
Thank you.